Thank you, everyone, for being here. Taxes is a vast topic, and we're going to focus specifically on NFT taxes. And there are some big changes that the IRS has initiated. First, let me introduce my team here, and I'm really excited to be with them all. My name is Donnelly. I run Crypto Tax Audit. We are a firm that does gain calculation, tax prep, and defending of people in audits with the IRS. We're one of the largest firms in the U.S. specializing in this field, and I'm really excited to be here with Andrew Gordon, his firm. Gordon Law does a very similar thing, tax prep, gain calculation, and legal defense. And so you have a real powerhouse here on the stage. And so I'll be able to turn it over to you first, tell a little bit more about your operation.
Sure. Well, thank you very much, Clinton. And as Clinton mentioned, I am the managing attorney at Gordon Law Group, and we do gain and loss calculations, meaning we determine the actual reportable aspects of your crypto and NFT trades, as well as tax returns and audit defense. And we also do criminal investigation defense as well. So we have a lot of experience in what can go wrong, and we try to use that to help keep our clients on the right side of the law instead.
Thank you very much. Robert?
Hello, everyone. My name is Robert Barton. I'm a partner at McDermott, Will & Emery. I do trust and estate litigation, so indirectly taxes. We deal with your estates when you become incapacitated and die, and so there's all sorts of valuation and tax issues that we are bracing ourselves for as this space continues to expand.
Thank you very much. Hey, so typically when you trade cryptocurrencies, you have to pay a tax on the gain you make from over the sale, what you purchased it at, compared to what you bought it for. And if you hold those assets long term, in the US, you get a benefit. You pay a lower tax rate, typically 15%. However, the IRS has announced their intention to enforce a new provision. It was not a new provision, it's been the law for some time, related to collectibles, that the long-term taxable gain on collectibles is at the fixed rate of 28%. And is very troubling because you might be expecting 15%, but in certain cases, now it might be 28. So that's the topic we want to look at because it's really targeting NFTs. It's not in a law just yet, but it could have some real big ramifications. So Andrew, can you elaborate on what that would mean to people?
Sure, and yeah, this is very important to all of us sitting here today. I assume everyone here is trading NFTs, and so this has the potential to, in some situations, double your tax rate on long-term NFT sales. Some people pay only 15%, others pay 20% on long-term crypto and NFT trades right now, but under the current proposal from the IRS, this would increase to 28%. And in many ways, the government has been on a warpath against crypto. But when it comes to tax specifically, the IRS has issued a lot of guidance over the recent years. And just a few weeks ago, they issued a notice saying that they intend to have NFTs in some situations taxed as collectibles. In this situation, however, they're allowing individuals and companies to inform the IRS of their thoughts. And so I urge everyone out there, talk to your local congressperson, even personally write to the IRS, because this is impactful and we do have an opportunity to change it. And so again, typically most people pay much lower tax rates. But here, not only would the tax rate increase, but it would also increase the cost of compliance significantly. Crypto tax reporting right now sucks. It is a pain in the ass. I don't know if I could swear here, but it is a pain in the ass.
Don't hold back.
And as a result, me and Clinton, we have thriving businesses because we're able to generate the crypto tax reports for our clients. But for many people, you just can't do it on your own. And now we're going to add an additional complication. Not only do we have our current tax rules, but we have to look at every single NFT with what the IRS calls the look-through rule and determine, is this NFT representing an underlying collectible? And if so, then it's at a higher tax rate. So it wouldn't be all NFTs, it would just be ones that represent collectibles. Well, which is that? In many cases, you'll be coming to myself or Clinton to determine that on a case-by-case basis. The crypto tax software out there, and there are several, none of them, as far as I know, have the optionality for NFTs to be deemed as collectibles. So this is going to be a very tedious, nuanced process that's going to vastly increase the cost of compliance, hopefully increase our business. But instead, I hope that all of you out there can join me in trying to make the IRS not adopt this change and keep NFTs as we all generally treat it as property instead of collectibles.
Thank you, Andrew. Maybe a little perspective. Why 28%? Well, it turns out 28% is basically the alternative minimum tax rate. It's basically a flat tax built into the tax code. The reason there is a special rate for collectibles, and by collectibles, the law generally is referring to, pieces of art like a Van Gogh, antique rugs, furniture, things that are really collectible, is because the very high, very wealthy people will buy these things. The prices and the valuations on these things are kind of, let's just say they're subjective, and they would transfer them at lower rates. But because they could finesse it, they weren't getting taxed at the rate that the wealthy people should be. They would be getting lower rates of, say, 15%. And so the collectibles is really to prevent tax evasion legal tax evasion by very wealthy people. But they're going to start to apply it to NFTs. It's extremely complicated, and as everything that Andrew said. One aspect of NFTs is holding them in your estate, and especially as you pass the ownership of estate, there's a whole slew of problems, as the previous speaker was alluding to. What are your thoughts on that, Robert?
Sure, and I just wanted to mention on that last topic, the public comment period is open, and one of the requests for comment is any areas of NFT taxation that the IRS should be looking at. It's essentially an open invitation, I think, to people who are interested in this area to provide. I think a lot of common theme is we need more regulation so that this can become more widespread adopted. And so I think the IRS is looking for people who are actually involved to comment on that. I don't think it's necessarily an invitation to self-assess tax, but they're going to find a way to get their money. So it's kind of a way to be involved in the process. There's been a couple presentations on this topic this afternoon, so I was here for most of them. I don't think there's a ton of overlap, but sorry for the people who attended all of those. But I wanted to talk a little bit, although this is mostly a tax-related presentation, the title is actually How to Save You Money. And one of the things where if my firm is getting involved, it's definitely going to cost you money because we're going to be litigating over your estate. And so there's a couple of questions or takeaways that I want you to take away from the seminar. As you are working, I assume you're here because you're either interested or you own an NFT. And if you have ownership in these assets, there's questions you should be asking your estate planner to make sure that they're properly dealt with. So the first question, I guess, is do you have an estate plan at all? And I realize for most people that is an uncomfortable conversation. They don't want to deal with it. You all look generally young and healthy. So people don't want to necessarily have that conversation, but we're starting to get situations where people got in a car accident, they're in a coma, and people don't know what to do with these types of assets. So, it's kind of just one of those things, you have to check the box and take care of your business. Secondly, does your estate plan specifically deal with digital assets? So one problem is people think, well, I already did that. I executed my trust, I have a will, surely it must take care of it. The problem is that a lot of these documents, they don't specifically incorporate digital asset powers. And so because the space has expanded so quickly, people just haven't caught up. And so without specific language, sometimes institutions are reluctant to take action if it's not specifically delineated in the document. So you need to ask your estate planner, does this deal with, name your digital asset, NFT, crypto, whatever. There are specific language that people who understand this area are incorporating into their documents. If you're not able to have that conversation with your estate planner, you should probably, and you have assets that are of meaningful value to you, you should probably be looking for a new estate planner. I think the reality is this whole field is in a catch-up mode. Most of the estate planners, they can't spell NFT. I mean, and they're much less plan for it. So they're catching up. There is a select group of people, I think, that are trying to become educated. The onus is going to be on you, though, to say, hey, this is what I'm doing as part of my balance sheet. This is what I own. Here's where my keys are, et cetera. And we've heard about different companies that offer various services and so on. The last thing is, will your estate administrator or trustee know how to administer these assets? Part of creating an estate plan is naming a trusted fiduciary to carry out your wishes when you die or if you're incapacitated. Unfortunately, people usually name someone that they are, well, I don't know if it's unfortunate, but the reality is that people often name someone that they're related to, who may or may not be well equipped to actually administer assets of these kind. Your Uncle Harry may be a great lawyer and an excellent civil litigator, but as far as digital assets, he may not have the faintest idea. Similarly, if your Aunt Sally can't open up the computer, probably not the best person to be administering these types of assets. But if you look on the other side, the sophisticated, the banks, the trust companies, the private professional fiduciaries, they're scared to death of this stuff. They don't want to touch it with a 10-foot pole. As far as I know, I think BNY is maybe like the closest, followed by Northern Trust. Like, these are the only two that are even I wouldn't even say they're willing to accept it, but they are trending in that direction. The rest of them have a no hold; they don't want to touch it, as far as I've heard. So, getting an institutional trustee to manage this money, it's just not going to happen. So, or I should say these assets. So, make sure that whoever you're naming is actually going to be willing to accept the appointment and do what you want to do with them.
Those are really helpful suggestions. Thank you very much, Robert. With the time we have left, I think it'd be helpful for everyone just to explore some tax savings ideas that you can be thinking about. What do you typically recommend, Andrew, to clients?
Yeah, sure. Thanks, Clinton. So taxes often not only have a bad reputation when it comes to crypto, but it's often an area that we don't like to think about. And I do want to thank you all for staying through this presentation. You guys have been an awesome audience. Only a couple of you have left, and you're here voluntarily to learn about taxes. So, wow, thank you all. But with that, I want to give you all a few pieces of actionable tax advice that you can take and actually minimize your taxes. If this was a presentation about how do you increase your gains 50%, I would probably be on the main stage. Instead, this is about taxes, and taxes have the power to increase your gains substantially and minimize your taxes. Taxes can be up to 50% when you consider state taxes as well, yet people often don't think about it. Well, today in this room, we are going to continue to think about it. And we're going to think about it with two pieces of advice that I'll give all of you today on how you can minimize your tax, and in some instances, not pay tax at all. Number one, we talked a little bit about long-term capital gains. So long-term capital gains applied to crypto and NFTs, at least as of now, under current law, and they apply as long as you hold that token or NFT for greater than a year. So one piece of advice, and it's not investment advice, you've got to make your own decisions based on whether you think a token or an NFT is going to go up or down. But if you're trying to decide which item of your portfolio to sell, if you look at those that are sitting in a long-term position and instead sell those, you can cut your tax rate in about half. So look at your holdings, identify which ones are in long-term. In order to do that, of course, you've got to do the accounting, you got to know what you're holding. But if you can trade based on that, you can decrease your taxes substantially. And there's different cost methods that apply, and there's different ways that you could select the tokens that you're selling. And by doing so, in some ways, manipulate legally your taxes. So that's number one, which is shoot for long-term capital gains, at least under current law. Number two is maximize your tax losses. This is perhaps the biggest tax loophole when it comes to crypto, and something that I urge all of you to consider using now or this year, because it is likely to go away. Not only is the NFT tax rate likely to increase, but a massive loophole when it comes to crypto taxes is likely to go away, and that is the wash sale rule. So right now, you can sell crypto at a loss, and this is another great strategy, selling crypto at a loss. But you can not only do that, but you could buy back that same crypto and still take that loss. When it comes to stocks, you can't do that. You can't sell your IBM stock at a loss and 2 days later buy it back. That's considered a wash, and the IRS disallows the loss. Doesn't apply to crypto, at least under current law. The Biden administration has released guidance urging Congress to change that. Congress has also tried to change it. It is likely to change. There's candidly no reason that crypto should have a benefit that stocks don't. But at least today, you can sell and buy back in a short time. With NFTs, it's a little bit different. They're non-fungible. But you could still sell an NFT that's sitting in a loss position and buy back a similar NFT of the same type. Perhaps there's 10,000 Bored Apes. You sell one, you buy back another one, you still have your tax loss. Why are tax losses important, and why is this such a good tip? Crypto tax losses can be used to offset crypto gains in the future. We all expect Bitcoin to hit 100,000 and 1 million in our lifetimes. And when it does that, we're going to be paying massive amounts of taxes, but we're going to be looking for losses to offset that tax. And we can realize these losses now and either use them in the current year or roll them forward to future years. And these losses not only offset crypto gains, but they also offset stocks and other property sale gains as well. So perhaps you are up on some stocks. You can use your crypto losses to offset that. And then up to $3,000 of income a year. But the big important part here is it can be carried forward year over year. So take those losses now or whenever it's appropriate based on your portfolio, and then you can always use them in future years. But you can't carry them back. So important to take them now. When it comes to NFTs, some of you might be thinking, I'm sitting on a portfolio of shit. I've said ass and shit in one presentation. This is great. Sitting on a portfolio of shit NFTs, what do I do with these? They may not have liquidity. You may not be able to sell them on OpenSea. There are different services out there that will buy your NFTs for a penny. And so sell them if you think that they're never going to go up. Get rid of them, realize that loss, take that loss either for current year or for future gains. So those are a couple tips. I hope you can utilize those and maximize your gains. So thank you.
Excellent, excellent ideas, Andrew. I think I'd add to that. Always people ask me, how can I save taxes? I say, what state are you in? Move out of that state. It's way too expensive. So and a lot of people are doing that as taxes are getting high in high tax states. Another big loophole for people is if you're very wealthy, you can move to Puerto Rico, which is the U.S. tax haven on purpose. And that's a great way, especially right now while the values are low. If you are someone I'd say who's over $1 million or $2 million in crypto assets, that would be an excellent opportunity for you to really save on taxes. And then I think if you have a large portfolio holding, you need to talk to a law firm that can help structure your holdings and maybe move those into corporations to help reduce the tax burden on your own individual taxes. So very much so, and I highly recommend, we have statistics that indicate that 50% or much more of Americans holding cryptos are not reporting that on their tax return like they should. So it'd be very important to encourage other people to be in compliance because the IRS enforcement machine is fully funded and ready to crack down. And so I highly encourage you to encourage everyone to file their taxes and to make adequate planning for inheritance purposes as well. So I think we have a few minutes left. Are there any questions?
Do you want to talk about charitable donations?
Oh, yes. We should talk about charitable donations.
Okay. Just a quick note. So another common way to reduce your tax burden is obviously, people know this, I think just generally speaking, donations to charity. It becomes a little bit more complicated when you're talking about crypto and NFTs just as a logistical matter. Most charities, I think it's safe to say, would prefer cash. It's cheaper for them administratively. However, I think charities are starting to recognize the opportunity that is here. However, the IRS has recently issued a chief counsel memorandum that has suggested, or more strongly than that, requires a qualified appraisal for any charitable donation over $5,000 for crypto specifically, and most likely it also applies to NFTs. So if you're going to make a donation of crypto, you need to get an appraisal. The Chief Counsel's memorandum specifically disallowed the taxpayer in that case's effort to get a charitable deduction of $10,000 donation because they didn't get an appraisal. It doesn't seem like that's that hard of a thing to do. You just hire someone to figure out what the value is, and voila, you have your appraisal. Unfortunately, especially for NFTs, figuring out the value for NFTs can be a little tricky. You have the currency valuation, you have the sort of the art aspect of some of these, and you also have the qualifications of the appraiser itself. This has not been in the mainstream for that long. The mainstream valuation companies are sort of just getting around to having people qualified in the space, and the IRS requires a qualified appraisal, which has specific definitions under the code. So if you are making a charitable deduction or a charitable donation to charity of crypto or an NFT, just remember $5,000 and to seek guidance about what kind of appraisal you need.
Appraisals will not be cheap because there's very few people who can do it. Are there any questions out there that anyone has? Yes, young man.
So on the realized losses, can you send that to a burn address as well, not just to sell it a penny?
Sending it to a burn address? What do you mean by that?
So for example, instead of sending it to a sell service for a penny, to burn it at the 0x0 address. So it's a realized loss for purposes of tax, but it's also not available to anybody.
You want to comment on that?
I could take it. So, good question. And so the IRS actually issued explicit guidance that if a token drops in value, that's not sufficient to deem a loss. You actually have to take some sort of action. Typically, that would mean a sale. And so the best practice would be to sell it to someone for a penny or use one of those services. However, in practice, sometimes that's just not feasible. For instance, airdrops. All the time there are scam airdrops, and just the intent of the airdrop is to get you to try to do something with it. So sometimes that's not feasible. The best practice would be sell it. The second best would be send it to a burn address. The third would be just to document that you've abandoned it. But yes, overall, any of those types of actions would be, in my view, an action that the IRS should deem sufficient to show that you've disposed of it, but there isn't anything explicit on anything like that the IRS has issued.
Thank you. Yes?
So the example that you stated where an individual has a couple million in assets, if you go to Puerto Rico or if you go to somewhere like Dubai and realize those gains, if you legally move there, stay there for a period of time, realize those gains, when you come back to the U.S. or come back to mainland, how does that work? Are you taxed?
So we're talking about U.S. taxation here.
So
So Americans are taxed on their income worldwide, regardless of where you live. So if you're Dubai, you're going to be taxed just as if you were living in San Francisco. All right. There are some special tax breaks that occur, but there's no tax in Dubai. So the U.S. will tax you fully, just as though you were here. Long-term gains, short-term gains, all the same thing. What makes Puerto Rico unique is the special relationship that Puerto Rico has, because Puerto Rico is not a state and it doesn't have representation in Congress, there's no taxation on income there. So what happens with a special incentive program that Puerto Rico has is that if you have cryptos, let's say it's $1 million now, and then I move to Puerto Rico today, okay, and now the current value today is say 1.5 million, but then later when I'm in Puerto Rico as a resident, it goes up, it's now 5 million. When you sell those assets, the portion of the gain that existed while you're in the U.S. is still taxed by U.S., but only up to that $500,000 gain there. The rest is taxed in Puerto Rico, but the tax rate is 0%. So that's what's very exciting. And that's why if you think a Puerto Rico option is something you're interested in, you want to move there while the valuations are low, not when they're high, right? So that's the key thing.
and once they're realized, can you immediately move back? Thank you. Sorry, I have to cut it off, but I'm
Okay.
sure you'll be available for questions right after. So you should follow up.
It's a complex topic, but yes. Thank you, everyone, very much for your time.
Act 60, thank you very much. Really appreciate it.